All right, so everybody's got to do their little got it thing. So with that, I'm gonna introduce Tim Gregory, who works with a number of select advisors who work directly with SEI like us here at Omega, handles business development for SEI. He's going to be introducing Matt Potter, but first a couple of words from Tim Gregory. And I want to just say thank you, Tim and Matt, for being here. We really appreciate these, really what's become sort of semi-annual updates from the two of you.
Thank you, Lisa. And thank you everyone on the call for taking this hour to spend with us tonight. I do think it's going to be informative, and I hope you enjoy it as well. As Lisa mentioned, we left a lot of time for questions, so feel free to ask them along the way, and we'll have time for question and answers at the end as well. My name is Tim Gregory from SEI Investments, and I'm joined here today by my colleague, Matt Potter. Matt's been with us for about 8 years now. I'll joke it feels longer than that, but he's been in the industry now for over 25 years. We'll kind of talk to his background a little bit, but he's a chartered financial analyst, which is really the highest designation you can receive in our industry. And believe it or not, has a background in psychology. I think he'll be the first one to tell you the parallels between investing and psychology. But if you jump to the next slide, I want to give you a quick update on SEI. I imagine most of you are a little bit familiar with SEI Investments. But where we stand today is roughly 4,000 employees. They're situated across 13 offices in 8 different countries. And like the Times, many of them are working remote today, and some are moving back into the office. But roughly 3,000 here in the US and about 1,000 overseas. Now, as an investment company, we today, as of the end of March, we directly manage, we advise on, and we administer more than $1.2 trillion in client assets. So while you may know of SEI today, most don't. We don't have much of a retail presence. We don't advertise our brand. And so I tend to joke that we're probably one of the world's biggest fund companies that most people have never heard of. We started managing money for clients, mostly institutions, back in the early 1980s. But we've been working with independent advisors like Lisa and her team at Omega almost 25 years ago. And today we work with advisors, roughly 7,000 across North America. Now that sounds like a lot, but really it is a very small exclusive group because there are hundreds of thousands of advisors across the country. And SEI really does self-select the firms that we want to partner with. We've been around since 1968. If you ever have any interest, you can see us trading on the NASDAQ under SEIC. If you jump to the next slide, I did mention our institutional clients. So we directly manage over $400 billion in client assets, about $100 billion from individual investors and families through our advisor partners, and the other $300 billion from institutions. Now, institutions are corporate pension plans, they are endowments, they're foundations, they're charities and hospital plans. Here's a sampling of some of those firms that we work with today. Not all of them, just those that let us use their logos in our marketing material. But firms from Panasonic to Pirelli tires to Mitsubishi to Mercedes-Benz, these are big global multinational corporations, and these are their own retirement assets. So if you think about it, they have the pick of the litter. If they think building their own investment process in-house is the best way to go, they have the resources to do that. If they think another firm is the premier investment consultant to hire, they can go that path. But year after year, they hire SEI Investments to manage their own retirement plans. And I hope you get a little sense of comfort knowing that you sit on the same side of the table as those firms. They put us through never-ending due diligence on an annual basis when they hire us again for them. On the next slide, we'll talk a little bit about the SEI investment team, which is why we have Matt Potter here today. This is really the brain trust of SEI. They're scattered across all of our offices, but today it's about 120 individuals, 121 investment professionals, really gathered in London, in Toronto. Oaks is just outside Philadelphia in Pennsylvania, and Hong Kong. About 70% of this group is a CFA, a PhD, or an MBA in finance. And their primary responsibility is investment research and due diligence of third-party investment managers. They are out there every day, going through every possible investment firm and investment portfolio team, looking for the best and the brightest to hire on behalf of all of our clients. And that is a never-ending process of manager due diligence, selection of those managers, and the ongoing oversight. So with that, I'll turn to Matt. Matt is part of our investment team. And again, before SEI, he was a client principal at Lockwell Investments, which was a boutique small cap value manager. He was a portfolio manager at Invesco and a portfolio specialist at Morgan Stanley and an analyst at Janney Montgomery Scott. So long after he stopped studying psychology, he made his way around Wall Street and hopefully found a long-term home here at SEI. Matt?
Great. Thank you, Tim. Thank you, everyone, for joining us. I've been doing these for a number of years. I always enjoy doing them. Probably would recognize many of you if I could see your faces. And I never have to worry about having something to talk about. Every year, there is always something. About a year ago, we were talking about the elections. Now those seem in the distant past. And we've been looking at really the kind of continuation of COVID and some other issues that have been brought up as the economy has attempted a reopening. To start with, I think it's helpful to set some context as to sort of where we've been over the past 18 months or so. This chart shows how stocks have done since the COVID lows of last year. And as you can see, they have been very strong. US stocks are shown with the solid blue line, international stocks from developed economies in the orange, and then the green line shows stocks for emerging market economies. And they have more than doubled. And this just goes to the end of September. Since that point, we have seen even more records. I read somewhere, I believe it has been 60 all-time highs for the S&P 500 this year. Something like 30% of all trading days in 2021 have represented record high closes for the Standard & Poor's 500 index. So the market has been, as the old saying goes, climbing a wall of worry. There certainly have been a number of issues to be concerned with or that investors could get hung up on. The most recent one being inflation, which I certainly will talk about. But even as we have seen challenges to the economy, whether it's another wave of the Delta variant of COVID-19, whether it's trying to get goods to consumers or hiring people for jobs or other issues too, we've seen a fairly relentless rise in stocks from last year's lows. You can see there have been a couple of dips of about 5%. But those haven't been really dramatic. And I think it's helpful also to take a look at what do normal markets look like in terms of volatility and in terms of kind of temporary pullbacks. Because we've had such a long bull market so far in a fairly short period of time. And I think it's useful to look at, what do markets typically look like? This chart shows the number of times per year on average, that's the blue bar, that you'll see the S&P 500 drop 5%, 10%, 15%, or 20%, which we label as dip, moderate correction, severe correction, and bear market. And as you can see, markets will drop 5% about 3.5 times per year on average. As I mentioned, we've only had two of those 5% dips over about the past year and a half. And we haven't had any 10% corrections since the COVID lows, whereas those typically happen about once a year. What's interesting, though, is that obviously not every 5% dip is going to turn into a 10% correction. In fact, only about 32% of the time, that's what the orange bar represents, will a 5% dip drop further and become more severe, as in hitting the 10% threshold. So markets can drop 5% for very little reason. The most recent drop we had like this was in September on some concerns about the slowing economy and inflation, and it was a fairly short-lived drop. Generally, if you don't have markets fall more, or if you don't see a recession on the horizon or a severe economic crisis, typically you'll only see 5 or 10% corrections. We would not be surprised if there were a bit more volatility ahead. Again, we've been at kind of below pace for these types of declines. But if there are more, again, until we see signs of a severe calamity, such as a recession, we would expect any dips to be relatively short-lived. Now, what's been driving markets higher? Well, the most important factor typically for stocks is corporate earnings. And earnings have rebounded very nicely, and the expectations for future earnings have also been quite high. You can see the bars, the gray and green representing actual earnings from calendar years, and then the more blue representing expectations, the consensus of Wall Street analysts for corporate earnings looking forward. As you can see, earnings since 1988 have certainly risen significantly with a few setbacks, and they are expected to grow even more fairly substantially. Now, whether they will achieve those growth targets, obviously we're not going to know until we get there. But I think one factor that has been behind the fairly solid recovery in earnings that we've seen this year has been the fact that companies have been able to be quite profitable. In fact, their profit margins have been at record highs recently. That's the chart on the right, showing one measure of profit margins. There are other measures as well. But again, companies have been able, I think the big factor here has been with rising input costs for things like raw materials, transportation, energy more recently, corporations have been able to pass those costs on to end consumers. Just one example, and this is just an example, not a buy recommendation or anything like that. Procter & Gamble has, I think, had 3 rounds of price increases for some of its products. And by and large, those have stuck. I think corporations have a pretty good sense of what their pricing power is, what they can charge, how much they can raise prices before consumers will switch to other brands or switch to generics or other types of goods. And again, by and large, they have shown the ability to raise prices where they've needed to and maintain good profitability, which I think has been a bit of a pleasant surprise this year. Another factor on the demand side has been consumers are in very good shape. The left side of this chart shows consumer assets versus liabilities, and you can see the assets far outweigh the liabilities. The balance sheets are in quite good shape. Certainly home values, we've seen those starting to rise. We've seen investments obviously rise quite a bit over the last 18 months, and the liabilities have been fairly low. With interest rates having been as low as they've been, that has certainly made the payoff of loans easier. And the debt service ratio, the chart in the upper right-hand corner, really shows that compared with where we were as we were just entering the Great Recession of 2008, debt represents less of a burden for end consumers. And again, with more discretionary income, with higher household worth, they certainly have been able and more recently willing to spend. Now, there have been some cross currents, though. We certainly have seen some issues most recently during the third quarter, a slowdown in growth. What this chart shows is the gross domestic product, probably the most common assessment of economic growth in the US. And there are 2 ways of looking at it. The actual reported GDP is the orange bars, and you can see it's reported quarterly. So, thus the shape of that. And then there's a measure that the Atlanta Federal Reserve puts out called GDP Now, which is more of a real-time estimate of where GDP is based on more high-frequency measures, and it gives a sense of sort of where GDP is trending. Over the last 5 months, or at least up until October, we had been seeing GDP Now trending lower, and it continued a bit following the end of the quarter. So when the first estimate recently came out for third quarter GDP, and it was slower relative to where it had been earlier in the year, we were not surprised by that, because really the more real-time estimates have been trending lower. However, if you look at GDP now it has been trending back up again. We had suspected that some of the factors that were driving this pullback in growth, such as the Delta variant of COVID, a slowdown in consumer spending, especially auto sales. The supply chain issues that have limited semiconductors have meant fewer new cars available. Dealers have largely been selling them, $5,000 or $10,000 over list price. And I think consumers got to a point where they said, no, thank you, I'm not going to pay that. There have been some other factors as well. We suspected, though, that the weakness that we saw would be temporary, that we would see recovery of the economy the first half of next year. And at least based on where GDP now has trended most recently, it looks like that may be in the cards.
Hey, Matt, can we go back to
Sure.
your last slide about corporations and pricing increases? If in some cases these are definitely supply chain issues. If they get sorted out, are we going to expect to have lower prices, or are the companies going to say, "Hey, we're marking to market here, and this is our new regular price"?
That's a great question, and I think consumers everywhere are wondering that. It's going to depend, I think, on the nature of the goods that are involved. Certainly, some items are likely to come back down again. I would say maybe consumables, maybe groceries, things like that. You tend to see a little bit more variability in some of those prices. But I think other items, especially if companies had not raised prices very much over the last 10 years because inflation had not been much of an issue, in some sense, I think they may have used this year as a way to sort of catch up to where they wanted to see prices. And, again, they do have a pretty acute sense of how much they can raise prices before they'll become an issue. So I would suspect, for some goods and services, you may see pricing kind of come back down again if, at whatever point we do see the supply chain issues resolve. It may take some time for those to resolve, but certainly I would think things like autos, where, again, the huge backlogs there have really, I think, driven prices way up. Those likely, I think, are going to come back down. But yeah, it's a great question, and I think it is. That's what a lot of company CFOs are looking at and trying to make decisions about what will their pricing look like, 1, 2, 3 years from now. And I believe that actually and that actually leads perfectly into this chart where we look at the supply chain issues. No doubt you've heard that there have been difficulties in a variety of contexts in terms of getting stuff to end consumers. This chart shows inventories, both on the manufacturing and trade side and on the retail side. And as you can see, they have dropped significantly this year. There have been issues on the manufacturing front. When you look at occurrences of the Delta variant, which have interfered with the production in a number of countries. We list several: Vietnam, Thailand, et cetera. So just actually getting either finished goods or components of goods, such as semiconductors, made, that has been an issue. And then getting them across the Pacific and unloaded, in particular in the ports of LA and Long Beach, there have been major backups there. I was actually out in Los Angeles a couple of weeks ago, and you can literally walk down to the water's edge and see all of these ships just sitting out there, many of which have been docked for weeks, waiting for their turn to be able to unload their cargo. And there was also a shortage of truck drivers in the US. So even getting them from the ports out to the distribution centers and to end consumers has also been an issue. So all of these have, the demand for goods and services has come back pretty strongly and pretty quickly. The supply, the ability to meet that demand, has again really been impeded. Whether it's little things like semiconductors or big things like Peloton bikes or everything in between, trying to get these items to their end destination has represented a challenge.
So Matt,
There, yeah.
one question
go
for
ahead.
you that came up in the chat is, what about housing? I guess I would say it's probably cyclical. We've seen it drop before in other recessions, but are we climbing to a new normal with housing prices as well?
Yeah, another good question. And I think a lot of that too depends on geography. We've seen some movement of people, especially with employees maybe a little less connected to, or less required to be less connected to, their home offices, the ability to work remotely. This could be a really important and longer term shift, which gives people flexibility to be able to live maybe in a variety of places that they might not have been able to before. They don't necessarily have to live right near where their jobs are. I've heard anecdotally of a number of people moving into places like Austin, Texas, for example. So some of that has been just, an influx of people and also the difficulty getting, building equipment to, create new supply of homes. That has been part of it. But housing prices also are impacted by interest rates, the affordability of mortgages. So as rates start to tick up, which we do think is likely to continue, if that leads to higher mortgages, that may also kind of have a dampening effect on home prices. But a lot of it, again, is really going to depend on geography and sort of where the flow of people is, and what happens with with corporate properties, and whether companies are going to continue to operate remotely, or whether you will see more employees come back into offices. All of that, I think, is still being worked through. So there's a bit of uncertainty around that as well. And I think, yeah, actually that ties into bond performance. The top of this chart shows for the 10-year Treasury, which really is kind of a baseline for many things such as mortgage rates. And as there's an inverse relationship between bond yields and bond prices. So as prices have gone down, that has meant yields have gone higher. And over the past year, yields were brought down very low by the Federal Reserve in order to really help re-stimulate the economy, to kind of get it back from the COVID-induced recession. And so rates have been rising from that point, starting to get back to normal. And so it's not surprising to see the 10-year Treasury with a negative return over the past year. But what's interesting is that not all bonds have acted that way. We are big believers in diversification at SEI. I've talked about it many times, and that applies to bond investing too. There are many different types of bonds. Some of them riskier, some of them safer, some of them taxable, some not, and they don't all behave the same. And so having a diversified portfolio of bonds, we think, is a good way to deal with an uncertain interest rate environment, just as having an active approach to bond investing also can be favorable, because bonds come in a lot of different varieties. Again, they'll respond differently to different kinds of conditions. There are even bonds that respond positively when inflation ticks up, such TIPS, the inflation-linked securities that you see on this chart as well. So as I mentioned, we do expect to see interest rates rising from here, not necessarily spiking rapidly, but as the economy returns to normal, as the Federal Reserve kind of pulls back from some of its extraordinary stimulus, and they have started to do that, we do expect to see higher rates. Now, again, an inverse relationship between bond yields and bond prices has led many people to be concerned, well, what happens when interest rates rise? Should I just get out of bonds entirely? We think that may be a mistake, and we wanted to sort of demonstrate why. So we ran a study, and we do have a white paper available on this, where we looked at where were interest rates 20 years ago. So that's the green dot over on the far left of this chart. And then you can see the path that interest rates took over the past 20 years. Now the dashed line represents, well, what if over the next 20 years, rates return to that same level where they were 20 years ago? What if we get a retracing of the past 20 years? What will that do to bonds? We had to make a number of assumptions and things in order to produce this. But what you can see from the bottom chart is, yes, there is a negative impact on the prices of the bonds themselves, but another important component of bonds is the interest that you get paid, the coupon from the bonds. And typically that accounts for most of your return as a bond investor. And as rates rise, that means that higher yielding instruments are available. You can get bonds that are paying higher interest rates. And that in all of these cases has more than offset the loss of principal value in the bonds. Again, an active approach to investing means that as rates rise, you can kind of adjust to what's going on, looking to see if there are more attractive issues out there, taking advantage of some of the higher yields that become available. So we don't think that rising rates always represents the death knell for bonds. It depends how rates rise, if it's expected, and if it's rapid or more gradual. All of those are factors, but we do still think bonds play a very important role within diversified portfolios.
So Matt, let me just,
Sure.
the other question we get is, well, maybe I should go to cash instead of bonds right now, which was your, point. And I'll wait till rates, come up, and then I'll get to buy cheaper, and somehow you're going to time the bond market in the interest rate cycle.
Yes, and market timing is extremely difficult to do, and we have yet to find anyone who can do it consistently. And economists, even professional economists, are notoriously bad at predicting even the direction of interest rates. It is a lot harder than it looks, and rates often can surprise you. Also, something that's important to keep in mind is one of the reasons you own bonds within a diversified portfolio, probably the main reason, is as a diversifier or a hedge against the volatility that's inherent within stocks. Usually, if there is a recession or if the stock market sells off, often what happens is there's a flight to safety. Money wants to move into the safest assets it can find, and that typically means high quality bonds. So if you just own cash, then yes, your money market, it won't drop as long as it's well managed, but it isn't going to necessarily give you a gain if equity prices come down. So it is important to recognize that bonds in those environments where volatility picks up, bonds can be very helpful, and they can help to offset some of that volatility within a portfolio. Another question questions that we get relates to inflation. We've started to talk about it, and we saw more data this morning where we saw that inflation increased meaningfully in October. And so there was the headlines of how much it had increased over the past year. I think it's important to point out a couple of things. One thing is that if you look back at last October, that had represented a pullback in gas prices in particular. So it was a little bit of a lower base than if we had looked at the year over year change, say from September 30th to September 30th. But there is no question that prices are higher. Certainly, some commodities have gone up, input costs have gone up, and we talked about the supply chain issues. When demand has been there consistently, but the supply of goods and services has been limited, that's going to lead to higher prices. Energy costs have also gone up. I'm sure you've seen at the gas pump. It's been very exaggerated or amplified in Europe, where natural gas prices have really spiked significantly coming into the winter. That's obviously something people don't want to see. We do think, and part of the debate has been, okay, is this inflation temporary? Is it permanent? Is it going, where's it going to sort of wind up? We do think we partly agree with what the Federal Reserve has or had been saying. They had been using the word transitory a lot to describe inflation, assuming that inflation was going to kind of come back down to what they saw as longer term levels. The measure they use is a different measure than the consumer price index, but they had expected that their particular measure was going to come down to around 2%. We think maybe inflation does pull back a bit from these levels, but maybe it settles at more like 2.5% to 3%. So it may wind up again being higher than what the Fed had originally anticipated. And I think many market participants have sort of come around to the idea that inflation may be more stickier than had originally been expected. One of the reasons for that has been wage inflation, has been rising wages, where I think labor has more of an advantage now than they've had in quite some time. There's something like 11 million job openings right now in the US and less than 8 million unemployed Americans who are maybe able to fill them. There have been a number of early retirements, and there may be some people who re-enter the labor force, come out of retirement, but that still isn't necessarily going to fill that gap. And so I think employers really need to give people more incentive to come back to the workforce, and typically that's going to mean higher wages. So that likely is going to be, we think, a longer term component of inflation going forward. We certainly don't expect to see inflation get to those really high levels that it was during the 1970s or early 1980s. But we expect to see it kind of in more of a normal range. You typically will see an inflation of something like 3%. And so we wouldn't be surprised if we kind of revisited those lows after the last 10 years. Obviously, when inflation has been lower than that, any type of increase feels huge. But again, we're probably just kind of getting back up to normal historical levels, as opposed to kind of going into a period of hyperinflation. Now, another question is, okay, assuming that inflation does stick, what does that mean for stocks? And what kind of stocks in particular could benefit or be hurt by rising inflation? Because we haven't really seen an inflationary environment in quite some time. Essentially, what this chart shows is that when you do see inflation, expensive stocks have the worst experience, especially on a risk-adjusted basis, but even just on an absolute basis. Whereas cheaper stocks, value stocks, as we see them, the less expensive ones that are often in more cyclical, economically sensitive areas, industrials, materials, things like financials, those look like they are maybe better positioned going forward than some of the kind of expensive growth names that we've seen do well over the last 10 years or so, often led by technology and other types of names. So again, this may be signaling a sea change in favoring a different kinds of stocks going forward than what we've seen in the past. And I think that's something that's important to keep in mind. And one of the reasons why we think an active approach to investing can make sense at this point, because you're not necessarily just wanting to buy an index. An index is going to have a lot of the S&P 500 has a lot of exposure to just a few very large companies within it. And so much of the performance is driven by just a few names. And if those names or some of those names kind of fall out of favor and other names that are less represented in the index do better, then owning the index may not give you the kind of experience that that you had been looking for. So that's one of, I think, the implications of what rising inflation could mean, both for bonds and for stocks. And in terms of our overall outlook, we always like to show kind of the good news, the bad news. There are always things to worry about. There are always things to be happy about. And while we did see a surge of the Delta variant during the summer, it does look like there has been some good news on that front with treatments, with the ability to expand vaccination. Hopefully, those will all help to bring COVID a little bit more under control as we move forward. And as we kind of slowly work through some of the supply chain issues, finally being able to get stuff to consumers and get people hired, all of that should redound to the benefit of the economy and help pick up economic growth next year. The Federal Reserve and other central banks are still, very supportive of the recovery. They don't want to see it fail. The Federal Reserve in particular is looking to have employment kind of get back up to higher levels than it is now. So that continues to act as a maybe less of a stimulus than before, but certainly still is positive. And as I mentioned before, corporations have been reporting very good earnings and have been very profitable. And we've seen that not just within the US, but also outside the US. I did mention we may see more volatility in the stock market going forward, but until and unless we see signs of a recession, which we don't, we think that any type of pullback, whether it's of the 5 or 10% variety, likely would be fairly short-lived and not, we wouldn't expect to see that materialize into something worse like a bear market. Well, we still are obviously keeping a close eye on inflation. We're also keeping a close eye on the Federal Reserve, what they may decide to do in order, depending on how the inflation outlook changes. They have already begun their process, or beginning this month, their process of pulling back some of their bond buying that they've been doing. One of the things that they did to try to help support the economy. And they hope to be done with that by sometime next summer. At that point, a lot of people have been anticipating, okay, once that ends, then we're going to start to see them raise interest rates. And that may not happen as quickly as people think. It will depend sort of on the inflation picture, but keep in mind also the Federal Reserve, the people making it up, there's going to be a fair number of changes coming. There was one member who was already going to retire. There are two others who kind of were forced to retire early given some of their trading activities during the pandemic. And there's another person who just announced his retirement coming up soon as well. So you're going to see 4 different governors replaced. Even if Jay Powell stays as the chair, we may see a different, a more dovish Fed, a Fed that may be a little bit more willing to wait before it starts hiking rates. So we'll have to see kind of what happens with that, but it may be a little bit too early to start predicting multiple interest rate increases next year, as some have already started to do.
And Matt, I'm hoping
yes.
you're going to tackle, this is DC, you're going to tackle that political issue around the debt. And is that going to cause inflation? Because that's the other thing that investors, at least that's what we hear from our clients, they're concerned about.
Yeah, and I think that part of that also gets to the tax and regulatory changes and spending changes that we may see. We finally got Infrastructure Week after waiting for it for several years. The House and the Senate managed to get a bill passed. So kind of that was part one of the spending package. Now we'll see what happens with the reconciliation package. But one thing I think that people have been heartened by is that these spending packages, there has been attention being paid to how are we going to pay for them so that they are not additive to the debt. Now, how that functions, the devil largely is in the details, and there are still questions about who is going to be paying higher taxes. It's likely you're going to see a minimum corporate tax, for example, maybe 15%, and some high net worth individuals will be paying more, but we don't yet know, is that everyone making over 400,000 a year? Is that billionaires? Is that somewhere in between? Some of those details are still being worked out. But I think the fact that there is more attention being paid to the debt and deficit is helpful in terms of the overall psychology of the market. But as I look back, I mean, in my lifetime, and I'm older than SEI is, there have only been 2 years where we have had a balanced annual budget. We've been running with deficit spending for a long time, and so far it has seemed to defy many of the expectations that the causes of inflation may not be as clear cut as, just increasing the money supply and expanding debt. So that it may or may not be contributing to higher inflation. I think the issues that we're seeing now contributing to inflation are really on the supply side. Again, the backlogs, the supply chain issues, those really seem to be the main ones that are causing it right now. But yeah, it certainly does remain a challenge. And, whether the political will result in order to sort of address it directly, it's hard to say. But at least the new spending that is being proposed in the same conversation, we've heard more about how it's going to be paid for, which I think at least gives some investors hope that maybe deficits are beginning to get attention that they haven't necessarily been getting recently.
Well, I think the other piece of that question, though, Matt, is, do deficits really matter towards inflation? The inflation we're having right now is for different reasons, as you've talked about. Does it really matter? Can we just carry the debt at low interest rates and it's not such a big deal as everybody thinks?
And I think that, and you raise another good question, is the big issue with deficits getting sort of when they're getting out of control is when servicing the debt becomes an undue burden, and that hurts the economy. And with low interest rates, servicing our debt has so far not been a problem. And there are a number of macro longer term factors that do seem to indicate, when you look at demographics, when you look at outsourcing of manufacturing and labor and things like that, it's likely that means over the long run that interest rates may persist at a lower, they may not get up to as high levels as they might be expected to. And if we do see an environment where rates are more reasonable, then it is easier to service your debt. Ultimately, people will lend. People do want to own treasury bonds because they want to have exposure to the US dollar. We still are the de facto world currency. And we are still considered money good. We have a lot of assets in this country, whether it's natural resources, whether it's our overall economy, land. I mean, all there are a number of ways. If we really sort of, I think people do see us as generally a good credit risk still, and as long as that continues, that generally will keep interest rates at a point where it is serviceable. It's really when that sort of stops being the case, and it is hard to know at what point that is going to be hit. But at least at this point, it seems like deficits they've gotten attention, but they haven't necessarily mattered as much as classical economics would say that they should. So with that, happy to take any additional questions that people might have. And hopefully some have been coming in, or maybe there are some that you've been getting from your clients.
Yeah, I've got at least one, and there may be some more as we continue here. So one of our attendees would love to hear your take on the future of market downturns. So with an activist Fed and the rise of investment vehicles like exchange traded funds, so basically index funds trading like stocks during the day, and automated savings through 401ks, will that lead to quicker downturns than we've seen throughout history? I looked at this and I thought, actually, this says to me that we probably will rally quicker. So just the opposite, but I'm wondering what you think about that.
Yeah, I think that's right. I think as long as you have a base of investors who are less reactive and who are longer term, and when you're looking at people's, retirement funds, when you're looking at corporations and large entities, large investors, I think that represents enough of a base that expanding into different vehicles, things like index funds, like ETFs, it doesn't necessarily represent, I think, as much of a threat of a sell-off. Just because something is easy to sell doesn't necessarily mean that people are going to be more inclined, to sell it when market volatility strikes. That's not to say that bubbles can't happen. There certainly are some areas of the market that do seem a little bit overheated, and there are certainly some types of newer types of investments that maybe haven't quite been tested yet. Some of the meme stocks or the cryptocurrencies, or we haven't yet seen how they might respond. But when you're looking at stocks, I mean, more and more individuals own stocks. And I think, a lot of people have been conditioned to look at the long term and say, hey, they go up over the long run. So if stocks fall, historically, they've always bounced back. So I think that would, give people incentive to step up and buy, as opposed to just sort of giving up on investments altogether.
Well, I guess I'm going to go at it a little bit differently, because I mean, and I tend to be the nervous Nelly here at Omega. I noticed where the S&P is now year to date. I don't know, it's 26 or 28%, at least as of last Friday. And Dow 36,000. And we took a hit last year, but it was really quick. When you show those charts, it was teeny. And I wonder, aren't we due for a little longer recession and market downturn at some point, or is that I mean, we don't have to do that.
At some point, yes, I think you have to believe that's the case. It's never as different this time as people imagine it might. And I think it would continue to be the height of arrogance to say that we no longer have to worry about bear markets because the Fed can step in and fix everything. And that's obviously not always the case. So yeah, it's likely at some point that something like that might happen. Typically what causes that is something you don't expect, is something you can't necessarily plan for. But yeah, we had a very quick recovery more recently. The 2008, obviously there was more issues there, but even then, I mean, once markets started getting going, they appreciated fairly steadily. It just took time to really repair the economy because you had such systemic damage that was done. But if something's in exogenous shocks like a virus, like September 11th, things like that, which sort of happen, aren't necessarily rippling throughout the entire economy, and maybe sort of faster, at least for prices to recover from. But yeah, you have to believe that people are still people. We're still human beings, and we still are overcome by greed and fear and pride and regret and other things. And as long as that's the case, history probably is a pretty good guide for what we someday will see. It's just a question of when and what would cause it.
Got it. And just to clarify from our last question, what the attendee was saying is because of automated 401k savings and ETFs, is it possible that the market downturns will be shorter in duration because you would have computerized trading kick in? You've got people on automatic savings into 401ks, so they would continue buying even in a market dip. So I think we would agree that could be true, but you never know, right?
Yeah, exactly. I think, yes, some of it does depend on, how willing are people to step up and buy, or again, if it's done on autopilot and they don't even have to think about it, that can often be a good way to kind of get money back into the market too. So yes, that's probably more likely, but yeah, every bear market is different. So it's hard to really generalize.
Couple more questions. So one of our attendees says this society is so spoiled regarding interest rates. In the 1970s, the interest rate on the purchase of my home was 8%. That sounds low actually to me. Do you see anything like this? And I'll say that I actually pulled out a mortgage statement from 2000 and our rate was 6.58. My current rate is 2.5. And for some of our younger colleagues here at Omega, right? They've never experienced anything even at 6.5 or at 8 or at 19. So curious what you and SEI see as the trends with interest rates. Are we always going to have low rates?
Well, it's hard to say always, but at least in the medium term, it looks like while rates may rise, they're highly unlikely to get back to, say, where they were in 1980 or 81. When you had CDs that were yielding close to 20%, when you had ridiculous levels of inflation and mortgages. And yes, having paid more for my mortgage and student loans than would have if they had come out today. I certainly don't disagree with the sentiment behind that. But yeah, again, there are a number of macro trends that do seem to be kind of maybe representing a ceiling on how high rates could get. So, while rates may drift higher, we think it's unlikely, at least in the kind of foreseeable future. But, again, we don't pretend to know everything or be able to see everything, but it does look like it would be more likely, we think, than not for rates to drift up, but kind of stop at a certain point that's much lower than what we saw in the 70s and 80s.
Got it. And I've got some more questions. So in light of these larger trends that you've been talking about, do shifts in currency values have much impact? You didn't really talk a lot about the dollar and currency and where that fits in right now.
Yeah, they certainly can. They can be particularly, when the dollar is weak, for example, that can be helpful for international stocks. It can be helpful for emerging market stocks, for assets sort of outside the U.S. And we have had a period of a fair amount of dollar strength. So if we do see kind of a shift to where the dollar even just kind of goes sideways for a while, or maybe begins to lose a bit of value, then the types of investments that could benefit from that might be things like international stocks. We've had about I think 14-year period where U.S. stocks have outperformed international, broadly speaking, and that's that's longer than typical. You go all the way back to 1928, they perform very similarly, but there are periods when the U.S. does better, there are periods when non-U.S. does better, and they're often correlated with the strength or weakness of the U.S. dollar. So yeah, if you're able to sort of predict where the dollar is going to go, and it's a little bit harder now, but again, if I had to flip a coin, I'd probably say a bit lower, which again could be supportive of things like international stocks.
Well, I appreciate you touching on that, because I think some of the questions we're getting is like, why aren't we just in the S&P 500? Why do we have any international? Of course, why do we have bonds? You've already addressed that, and we certainly pull out those diversification charts. And at least you can make the case for emerging markets. We started the year strong on international and emerging markets, and then it all petered away. I think primarily because of COVID. But I don't know if you want to say just a couple things about where SEI thinks international fits in, and sort of how you're weighting at this point.
Yeah, we always like to have a good allocation to international. We don't want to have the home country bias where you have so much of your portfolio in one country, even if it is the US and even if it is kind of the central economy. When you look globally, the split of stocks sort of across the board is maybe about 59 or 60% US, the rest of mostly developed international, but some in emerging markets. And, we do think that particularly if you look at, say, Asia ex-China, and certainly China has had a number of issues this year. I mean, we've seen it not just with Evergrande, but also the regulatory environment and a slowing economy. If you take China out of the emerging markets, a number of other ones, the economies and markets have actually been doing fairly well. There is a decent amount of growth there. There's some good demographic trends. So, whether China obviously is a huge economy, whether it still should be considered an emerging economy or not, I think reasonable people can disagree on that. But, when you're looking for sort of where is the next phase of growth likely to be, as you see more of an emerging spending consumer class, more people sort of rising out of poverty and able to to be productive and to be able to kind of contribute to the economy. That certainly, I think, would bode well for emerging market economies. And also going back to the idea of growth has been doing well for a long time, which means technology has been doing very well. If we see a shift away from that, the US indexes, technology is pretty heavily represented. And quasi technology companies that maybe aren't put in the technology bucket, but act like tech stocks, if there's a shift away from those into kind of more traditional cyclical names, those would, that certainly would help an area like Europe, which is sort of like one big cyclical value stock, and probably would also have a positive impact on parts of the emerging markets, including Asia. So I think there are a number of reasons why, over the long run, we do think that those areas are due at some point for a period of good performance. Since we can't necessarily time when that's going to happen, we think diversification really is sort of your best way to have some exposure there. So, if the tide does turn, you won't be sort of waiting for the trend to assert itself before you actually, get into those asset classes.
Yeah, and I'll come back to that point in a minute. You've mentioned it a few times, and we are definitely getting questions from our clients about this. Is cryptocurrency going to be at all involved in any of your investment strategies in the near future?
Not anytime soon. We've put out a paper. I think it was in January of this year, but it was called something like "Why We Don't Own Bitcoin or Any Other Cryptocurrencies." So it's pretty clear. These are interesting, but how do you value it? A crypto is not tied to an earnings stream. It doesn't produce income. It doesn't have kind of an intrinsic inherent value to it. And if you can't price something, you can't know if you're paying a good price for it or not. It's not really an investment. It really is more speculation. The main reason most people, I think, have been buying them is because they've been going up and they expect that they'll continue to go up. But fundamentally, it's hard to know. And it's also hard to know, which one is going to wind up being the best one or the only one. What will government regulation start to look like? China's already started to, crack down on Bitcoin. What could happen with the other cryptos? And are you going to see like larger financial institutions? Could JP Morgan Chase or Goldman Sachs create their own version? And if they did, I don't know that I'd want to bet against them. So it's a newer asset class. It is more speculative. So it's not one that we're investing in right now.
And just to add some company perspective too, if you look at SEI as a corporation, roughly 50% of our revenues come from building and providing technology that we sell into the financial system, and 50% from investment management. And on the technology side of SEI, we are heavy investors in the technology behind Bitcoin and cryptocurrencies, which is blockchain technology. So the technology itself, we are heavily investing for the future growth of our business. We see a lot of viability there. To Matt's point, it's the speculation of cryptocurrencies as a pseudo asset class that we're still watching. To Matt's point, we put out a paper on it a few weeks ago. So we are not dogmatic. It's just when we look at every available place where we can put our client dollars, we just continually find better options than cryptocurrencies.
Yeah.
I appreciate that perspective, and it shows the innovation is, that blockchain, the technology that's behind cryptocurrencies, is something that you're embracing. It's just we're avoiding the speculation, and I think honestly, that's exactly how to describe it. And that's not what we're investing with you for. We're not investing with you for speculation. We're investing with you for solid, long-term, diversified strategies, right?
Yeah, just like, the internet obviously was a very important invention, and it certainly has helped a lot of industries, but pets.com, not so much. So the technology behind it can be disruptive and helpful, but even bigger traditional companies can benefit from it. So yeah, it is. I think that is an important distinction.
As we wrap up, I just have to, I think, share this point of view that here you are overseeing, over $1 trillion, managing all of this, these assets for clients. You've got all of these financial analysts all over the world. And, the bottom line is you're not making a bet on any one area. We don't know where the best place to be is. And I know some people are going to say, but you should know. And I think if you could sort of address that, and I want to bring things home as we wrap up today. But, the reality is we don't know, right?
Yeah, I think humility is a very important virtue, and it's not always seen as one. Facts on the ground change. Things happen that are surprising and unpredicted and unpredictable. And we certainly can look at historical trends and see, well, it may be more likely that this happens than that happens. But with investing, you only get to do it once. And even if something would have worked 99 times out of 100, well, what if it's the one time when it fails? Do you really want to have that much risk? And when you're talking about people's wealth and their livelihoods, it just doesn't make sense to do that. So yeah, again, being diversified, trying to know as much as you can, but also trying to know what you don't know and what you can't predict is very important.
And I really appreciate that. I think what we sound a little bit like a broken record at Omega, but we really believe in the goals-based approach, which is why we have partnered with you going on now 22 years. We had our first account in 1999, and then we brought a bunch of money over in 2004. Is that goals-based approach, that aligning money you need in a shorter term time frame with a shorter term strategy, money that you can afford to grow and ride the ups and downs. We can be more growth oriented, but that's really the only way we can help our clients manage through the unknowns and the volatility that is ultimately going to come, right?
Yeah. Yeah.
So we appreciate both of you being here. Thank you for all of you who've attended and for your excellent questions. We'll be getting an email out on this. I'm going to try to attach a couple, the crypto white paper, and then also the bond white paper, because I think both of those could be useful to our clients. So thanks again, Tim and Matt. We really appreciate you being here, and happy holidays.
Our pleasure. You as well. And to everyone who's watching.
Thank you so much.
Thank you. Take care.